Good morning, good afternoon, good evening. Thank you for joining our webinar today. My name is Ankit and I'm the co-founder of BIGGR Financial. BIGGR is a platform of India's leading registered investment advisors who can help you with investments, insurance planning, retirement planning, and other goal-based investments in a conflict-free and an unbiased way. Coming to our webinar today, we have Mr. Prasanna with us. Prasanna is an investment specialist at Rupeeting, and previously in his role, he had worked with iconic Dalal Street General, where he was head of equity research and has rolled out many successful products. He also worked with Pentat Securities in their equity division, where he held numerous HNI clients' portfolio and assisted them in equity investments. He has run almost 200 investment awareness programs all over India and also worked at Loya Securities. So welcome, Prasanna. Pleasure to have you here today. And before I hand over to Mr. Prasanna, I have a quick poll for our audience. So this poll is coming on your screen. So please vote. So we are actually asking that whether how many people are investing in equity, and whether if they are not investing in equities, then what is the reason for that. So please vote. The poll should be on your screen. We'll wait for around 10 seconds. Okay. Yeah, so I see people are still voting. So let's give a few more seconds. Yeah, okay. So I'm going to publish the results. Over to you, Prasanna. So you can start sharing your screen. Able to share?
It's not.
Now try sharing.
It's done.
Okay, okay.
Visible to everyone?
Yes, should be visible to everyone. Yeah. So over to you, Prasanna. Okay. Yeah.
Thank you, Ankit. Hello, everyone. Good morning, good afternoon, and good evening to many of you. So I'm Prasanna Bidkar. I'm here to present about few of the stock picking ideas and strategies which are so-called as proven strategies in equity market. Okay. So first of all, let me tell you, I'm going to put very simple ideas to you, and this is not very complex structure where you will be giving, you will be given a lot of financial crunching, numbers crunching, and everything. So what we feel is anything which is simplified is better for you. So we are going to simplify things, and putting into that those parameters, it will be easier for you to find out a good multi-bagger, or we can say a good stock to invest for. Okay, so let's start. Okay, first of all, when we speak about equities, so there are few myths which are being considered when it comes to stock market. And first of all, it is like it's like gambling. So I will let you know it's not gambling. It's a very we have a organization which is called SEBI, and apart from that, a well-researched stocks and investments always gives you a good return. Okay, and second myth that comes to when it comes to equity market, because look, when we speak about equity markets, we are talking about risk, and as we are taking risk, naturally the returns are expected to be higher than what we expect from risk-free returns. So naturally there is a risk, but the problem is people consider it as that they have a lot higher expectations from equity market. Okay, so like people I've seen considering that, okay, I can double my money in no time. Like you can, if I can correlate this to one of the movies where in Hera Fairy 2, when they say that 21 दिन में पैसा double. Okay, so that is what is expected from equity market. So anyone who wants to get rich quickly, they feel equity is one option for me. And with now options like future and options being provided, options writing and everything coming up, a lot of people feel that making money is easier. In last 2 to 3 years, a lot of people have only seen one-sided one move, and they feel that it's easier. Look, I will put it very frankly that equity markets are simple but not easy. So we need to keep it simple, and that only helps. Okay, so we need to have rational expectations from market. So what kind of rational expectations we have? Okay, when I speak about rational expectations, I need to look at how indices have performed over the last 1 decade, 2 decade, or long-term period. Okay, so when I speak about long term, it's 10 years, 20 years, and Nifty 50, which are index. The long-term CAGR is around 14%. It comes between 14 to 14.2%. So if I consider a CAGR of 14%, it takes 5 years and a quarter to double my money. So that much patience I need to have when I invest in equity markets. Usually, and that too also when there is a consistency in market. Okay, so if there are there is a prolonged decline or bearish market which comes out, and there are certain significant events that have occurred, naturally such kind of events may reduce those kind of returns. But overall, on an average, CAGR 14% is what I now 14% is not a benchmark, but it is higher than risk-free returns. So what I want to put up is when I'm taking a smaller risk, which is higher than what is perceived in risk-free markets, I'm getting something better, and that is what I'm looking at. So if someone says I can double your money, and uh, if they ask you that we are going to invest in some products where you can double your money in a year or something, it's very difficult. Look, doubling your money in 21 days, it's not possible. I'm telling you very frankly, it happens. It's either by fluke, either by luck. But when it comes to equity markets, we only need to consider time. Then only compounding happens. So over a period, when compounding happens, then you can only generate higher returns. Okay. So a simple formula for when we generate returns is P plus R raised to the power n. Okay, that is the principle into rate to the power n. So everyone looks at that R. No, we need not look at that R. We need to look at n. N is the time. So number of years you could stay invested and put your money invested. That is what the real returns are expected to come. Many people take it as an income source of, look, if you are here in equity markets to generate monthly income or yearly income, it's very difficult. Equity markets are here to make you wealthy. So it takes time. I will put a very simple story in Hindi. Okay. So there was a monkey, एक बंदर था, and he was every day coming to one house. A man used to like वो एक पौधा लगाने के लिए बीज बो रहा था. So when that monkey saw him कि यार यहाँ पे he's sowing up a seed, and after few days a plant comes out of it. He was watering that man was watering that plant, and so that monkey was like, okay, even I want to do this. So that monkey came out with a seed. He put it into the soil. Next day he comes up, he again opens up, nothing happens. Next day again he comes up, nothing happens. He's trying to water that plant, but every day he's like coming to that seed, opening it up, taking out from the soil and looking at it. So what happened is nothing actually came up, because some things that seed needs time to convert into plant, and same is applicable to equities. So we need to be that man who is throwing up and watering that plant, not that monkey who's like taking it out and every day watching it what's happening. So that's the basic. Okay, so it needs time, it requires time, and that time should be given. So when expectations are higher, okay, when expectations are higher and we expect some unrealistic returns, the mistakes are bound to happen, and we need to avoid those mistakes. Look, when we are making a statue or something, or creating something like a statue, what we do is from that stone which is being carved, we just take out unwanted part. Okay, and that statue becomes a final product. So similar way, even in selecting a stock or a portfolio, you need to take out what is unwanted, and that unwanted thing is what we must focus on. Look, if there are 100 factors of investing, there are out of that 90 are what to do and 10 are what not to do. So rather than focusing on what to do, which is the larger part, we need to understand what not to do. Okay, so there are few do's and don'ts when we try to pick up a stock and we are trying to make a portfolio. Okay, so first thing what we have till now learned is it's a basic that you need to rationalize your expectations higher than risk-free returns, a few basis point. That is what one should look at, and one should look at a longer-term investment scenario. So I just spoke about that when we keep unrealistic expectations, there are mistakes we are going to commit, and we need to avoid such mistakes. Okay, so let's focus on first what exactly we need to avoid. Okay, so first of all, when we are trying to pick up any stock, these are the 6 factors we should avoid. First and foremost factor is avoid a hot stock. Okay. Now everyone will be amazed to will be wondering what exactly hot stock is. A hot stock is, in very simple terms, is whatever is consistently making it into news. It is continuously moving up. Each and every person you know in stock market, every participant is talking about that stock. Have you invested in that stock? Continuously it is moving up. There is a kind of fear of missing out kind of factor applicable to it. And just because that stock is moving up, everyone is speaking about it, whether it is followed by backed by fundamentals or not. So what happens is, when we try to focus on such stocks, we are not focusing on fundamentals or value. So it is very simple. What we pay is price, and what we get is value. So we need to find value, and hot stocks lack that value because already it has moved up. It may be running ahead of the fundamentals. There are a lot of stories. There is a lot of liquidity chasing those stocks. A lot of retail participants chasing that stock, and it results into higher valuations. Look, if there is something which there is one product which cost me 10 rupees. I know at the max I can give you 10 rupees because of scarcity of that product. But I am not going to pay 20, 25 or 30 rupees. Because if I am paying that much higher price, it takes that much time to recover when actual fundamentals are following it. Okay. So fundamentals, we'll speak that into the second part, and later I'm focusing on that fundamentals, what to look at. But we must avoid hot stocks. Okay, there are a lot of hot stocks we have seen. I won't name those companies right now, but just a recent example would have been like any Adani stock kind of stocks which were continuously moving up. There might be one reason. I am not commenting whether it is good or bad, but that has moved up, moved ahead of the fundamentals, and that has resulted into massacre later on. Okay, so we must avoid such stock. We need not pay any price. We need to give a right price, and that right kind of price, how to decide that we will discuss in the second part of this presentation. Okay, so avoiding hot stocks. Always avoid such hot stocks. You are paying up higher, and the kind of expected returns, which are I'm talking about, rationalized returns also are not expected within, because these are momentum stocks. Momentum stocks may give you 2-3% returns or 4% returns when you enter. But if your timing is wrong, if you enter at a peak, it's very difficult to come out of that stock. And the biggest problem retail investors face is they don't keep their winner. They just keep the losing stocks in their portfolio and keep it holding for long term. And then it becomes a dead stock. Okay, there are many examples. I won't name those companies, but there are many hot stocks which have run up. Then people got into at higher price, and the such hot stocks didn't give any kind of returns. Just many retail investors got stuck into it. So avoid such hot stock unless and until it is followed by fundamentals, which is like 3 to 5 years of financial performance. Then only we can get into such stock. Otherwise, momentum stocks are usually considered no if you try to find a multi-bagger. Okay. Again, I have just missed out on one point that look, we usually focus on portfolios. Now everyone will say, if I can find a multi-bagger, I will hold that one stock and I will run it for my life, and then it will make me wealthy. But look, finding that precise multi-bagger is very difficult. No one is God here. Everyone is human. Everyone is picking up their stock based on research, and it may be a view may go wrong. So it is told that yes, fortunes are made by investing in single company, but again, remember, even misfortunes are made so. So not a single company. We need to get into portfolios, and that also how to match that portfolios. We'll take it in the as the last part of this presentation. So avoid hot stock. Always avoid hot stocks. Now the next part that comes in is next something. Now this is the biggest mistake everyone does. Okay, they always look for what the past has been in the past, which company has provided returns, and trade. They try to find out similar companies from that sector. And there are stories which are being made out that okay, this is next something. I will give a very simple example of that. Like I still remember, Punj Lloyd was considered as the next big entity. What happened? Similarly, Yes Bank was considered as the next HDFC Bank. So next big something. There are many examples that come out to our mind. In real estate also, we had seen that companies like many companies like Unitake and have our wall were being sold like okay, this is next something. This is the biggest thing which is happening. So next big something. I will give examples of few other companies also. Okay. And look, when we try to emulate someone, it is not necessary that we will be successful as similar to that person. And what is applicable in life is also applicable in markets. So never, if we are applying that condition in our daily life and daily routine, we must apply that condition in markets as well. So if someone is trying to emulate, I still remember I met Punjloid people. I was fortunate to meet the management, and every time I met them, they were coming out with some new segment, new sector, constant acquisitions and all. They wanted to buy everything, like whatever field L&T was into or segment L&T was into, they wanted to be in that segment. So, and it was being told as a story to everyone that Punjloid is the next L&T, and we know eventually what happened: debt traps, then wrong acquisitions, how it affected them. So next something. Even in case of next something, I will give an example of Utlon. It was considered to be the next big thing in we can say power segment. That yes, renewable of something. Company idea was good, everything was good, but the execution was wrong, and we know what happened. So next big thing. If you feel that there is something called as next big thing, we need to put a question mark. I also remember there was one company called as Tulip IT Services, and they were providing last mile connectivity. At the time of IPO, I met them and I was trying to understand their business. And unfortunately, I was not able to understand what exactly they were providing. Okay, a lot of people from IT were considering it as okay, this is the next big thing. They are providing last mile connectivity. They will be everywhere, and we know now not many companies are there which are with not many people who recently came to market even know there was something called as Tulip IT services. And there is one another example which I guess one of the best examples to put into this category is in 2006, 2005 or 6, there was a company known as Geodesic Services. And Geodesic was into IT services, and it came out with a very good idea where even WhatsApp and all was not even invented. And they came out with something called as a messenger. And the product name was Mundo Messenger. They were ahead of time since they were focusing on IPTV and everything in 2004-5. But eventually, what happened? That product, what they showed as that this is the next big thing that didn't happen only. Eventually, FCCB issues, debt issues, management wrong decisions and acquisitions led to something which only resulted into collapse of that company. I don't know how many of you know what GeoDC was about, and if you could search about that company, we'll get to know means how exactly next big thing or next something actually affects, and it just asks for higher valuation and price, and your returns are hardly anything. So next something we must avoid. Okay, over diversification. Third part is over diversification. Okay, over diversification. Yes, diversification is good. You need to be diversified. That if one sector is getting affected, you are having a business from other segment. Your margins are surviving, and your sales growth and everything from other segment is helping you out. But again, Then comes over diversification. We have seen a recent example of one management getting into each and every business, whether it is cement, whether it is power, whether it is renewable, whether it is FMCG, everywhere, and that results into over diversification. And look, when I speak about any company and analysis of any company, more than financials, there are two parameters which we actually consider. One parameter is quantifiable, and second is not quantifiable, which is qualitative factors. So quantitative factors and qualitative factors. So quantitative we can look at the financials and everything, but qualitative factors, management is the important part. So what kind of, and when it comes to management, their capital allocation is the most important part. Okay, so how the capital allocation is done and how it gives you returns is important. Recently we have seen that idea where Birla Group had mentioned that we are not putting any more capital into telecom business. They have survived. They are somehow they survived, and there were hardly returns which they could generate, and they were not committing any more capital. So while everyone was idea is not good, but then not putting more capital into loss-making businesses and where they are suffering, it's a good idea. So capital allocation is very important. And when you allocate capital to each and every business where you don't even have expertise or we are not able to manage it, it's very bad for company. Okay, so a bad capital allocation is always hurtful. So try to avoid where there is a over diversification. Diversification is good, but over diversification is bad. Then we come to aggressive acquisitions. Okay, this is one segment where okay, in over diversification, we will give an example of one factor that where actually there is company listed as BRL. They are into logistics and everything. And suddenly one day they came out and they mentioned that okay, we will get into something called as aviation. So we want to try that sector also. And immediately you can see the impact on the stock price. So diversification, unnecessary diversification that happened, and it affected the stock. The stock is yet to recover to those levels. It's very difficult when management tries to try their hand in businesses they hardly know, and we know that the capital allocation policy will be affected. Okay. Then it comes to aggressive acquisitions. Now, when we talk about aggressive acquisitions, I will give you one example. Look, there are many companies which have done good acquisitions and made them profitable, but they have paid price as well. Okay, I will give you one example of company called as Opto Circuits. They were into diagnostic equipments which are electrical diagnostic equipments. A nice company, very good growth it was showing, but it was all inorganic growth, and all inorganic growth was done when the market valuations were higher. 2005 to 8, they were catching up with every each and every business. So what happened eventually? A lot of debt appeared on the balance sheet, and it affected their ability to pay interest, and sales growth didn't match accordingly, and it affected their business eventually. So we know how Opto Circuits has declined. So aggressive acquisition. Look, not many would agree, but yes, even there were some aggressive acquisition done by larger group also, but then they had deep pockets and they managed. Look, even Tata's had to face some issues when in 2008 JLR was acquired, and it took some time to come out of those. So JLR sellers were at the advantage, but buyers were not. It took some years, more than 5 years, or you can say a decade, to come out of that. And so aggressive acquisitions is one which we should avoid. Then there comes whisper stocks. Okay, this is one thing which I try to avoid. Means these whisper stocks. Let's first understand what whisper stocks are. Whisper stocks are like they are not openly traded, or these companies, you don't get information about those companies in open domain, but you get to know about these companies whenever we attend analyst meets, press meets, or we meet some friends and same similar kind of business people. So it will tell you something which is like it will resolve the country's current ongoing problems. Either it will be like there will be something, some company, medical company coming out with which cures HIV. With there is something which will cure COVID, will not will be getting affected by COVID, or something I had one company experience where the management was saying if we are successful in our research, people won't die. So this is kind of the stock stories which are being sold. Okay, everyone comes across those stocks, and the best way to avoid the stock is to just ignore nothing. Apart from them, do nothing. Whisper stocks are only stories, and stories are only sold in Bollywood or nowhere else. So better to avoid such stories, and whisper stocks should be avoided because eventually they will only and only lead to losses. So better to avoid such stocks. Okay. Now the last part which comes into this is exciting names. Look, recently we have seen that. So look, when we try to select some companies or something, we try to find out sectors. Okay, and sectors are rotating. This is also cyclic in nature. So what happens is when we try to focus on such sectors, companies try to put up such names and take out some names because when from 2004 to 2008 infrastructure was the story, each and every company came out and put up their name as infrastructure company, XYZ infrastructure, and the story changes. Even in when dot com bubble was there, everyone wanted to be named as a technology stock. I still remember one company named as IKF Technologies. Okay, IKF Technologies was a company. Now from the name it appears that it's a IT company and something. So we were also trying to understand what exactly is resulting in this company giving so much of returns in very less time. And we met the management. Then we came to know, no, it's not any technology company. It's a biofuel company where, and not even biofuel company. They were calling it as a marketplace for biofuel where Jethrofa seeds will be auctioned and sold, and all companies will be coming to buy those Jethrofa and then converting into biofuel. Eventually, all know what happened to IKF Technology. So, such stocks, whenever constant name changes. Recently, we know there is a BCG Brightcom group and everything. I had put it on my Twitter handle also to avoid such stocks. A lot of trolling also was done. But what happens is exciting names, constant name change are a caution mark. So what happens is we need to put a lot of caution when constant name changes happen or companies are putting their names as an exciting name. Okay, so try to avoid
Okay.
it. If
Oh,
you try to
sorry to interrupt, Prasanna, but we are running out of time, so we may have to expedite a
okay,
little
okay,
bit. Okay. Yeah.
fine. I will just put it in.
Yeah. Thank you.
Okay. Okay, so I will just take I guess 5 to 7 minutes more. Fine. So while I have understood what exactly we are looking for, so we need to understand that what to look for. Okay, so these are the 8 factors which one must look at. Look, people look for hot stocks and exciting businesses, but you won't find a multi-bagger stock in exciting business. We need to every time. Very boring market is where you make a lot of money. So dull business segments, which are doing not good now. Metals, oil and gas are where sectors which are cyclical. When they are down, the prices are lowest, the business look dull. Then only similar applies to the boring names. You may find okay, there are very boring names. Pretty like we don't know exactly what that many companies. Yes, being an advertising, they are very good at it, but there are boring names, boring segments. Such companies are going to give you a good company for a longer term investment. Okay, so dull segments which are doing not good now but expected to do in the future. There are spin-offs. Okay, I told you that over diversification is bad, but if there are certain companies where we need to look at the spin-offs also, that they are having one segment which is as large. If given a proper capital allocation, it becomes very large. So Jubilant Organosis had one subsidiary, and Jubilant Foodworks. We know how it has given returns. They came out with 2 3 companies. Similarly, recently, what happened with other companies was spin-offs. So if there is one segment where additional allocation can be done and it gives you good return, it's always good to find some spin-offs. Okay, and there is no growth industry. I told you that growth is momentum. So we try to chase growth, but the best way to find a multi-bagger is where right now there is no growth. Okay, so try to avoid growth sectors and try to focus. Look, in 2020, when everything was down in March, no one was trying to invest. When markets are at peak, everyone wants to invest. But when market is at the bottom, when everyone is selling, no one wants to buy. So growth industry you should avoid. Okay, so that is the fourth part. They should have their own niche. I will tell you, like, niche or mode, we can say, like demand, everyday low price. They have their own niche. Pidilite, they have their own niche. They are selling their products since long, but innovation, constant innovation, and sticky customers. Like the customers coming back to you, and whether it is demand, whether it is, even I will say Bajaj Finance, which are based by technologies, everything is business. So business, your product which is scalable and sustainable. Those two things having a moat are most important factor. Okay. And insider buying and liquidity. Look, insider buying is when your management tries to buy, and we need to look at, we get that data on BSE website. It's always good to have, if management is buying, they know everything. Okay. They are the decision makers. If insider buying or management buying is happening, it's usually a good thing. Try to find out stock where management is buying. And liquidity. Why I am saying liquidity in stock? Look, entering any stock is very easy, but it is the exit that makes you profit. So try to find out companies where you can exit properly. There is a lot of liquidity. I've seen people in 2006 who actually got into good mid cap companies in 2005, but were unable to exit in 2006 when the market declined was just for few days or 2 weeks or 3 weeks, and everyone lost their money. So liquidity is one important factor. Things to look out for, these 8 factors you need to look at, and liquidity is the most important factor because everyone knows how to enter, but exit is always a problem. So try to look for liquid stocks. These are the few parameters. Look, I told you that what I look for is like revenue growth, where long-term CAGR growth is more than 15%, and profitability should be in higher single digits. I'm not expecting very much high. So revenue growth, long-term, which is when it comes to long-term, not less than 5 years and up to 10 years, we need to look at. So 15% is what we must look for. Then profitability. Again, higher single digits is good. Interest coverage ratio. Look, I will first look at a company which is debt free. Okay, usually I look for that those companies. But if there is a debt, I need to look at interest coverage ratio, where my EBITDA, earnings before interest, depreciation, and taxation, should be at least 2 to 3 times of my interest cost. So that is where the interest coverage ratio comes up. So try to look for a debt-free companies which you'll find. And but if there are debt companies where compulsory debt is required, we need to focus only on companies where interest coverage ratio is better. Okay, cash flows. This is most important. But what is said is your top line is vanity, bottom line is sanity, and the only reality in market is cash flow. So we must look at the companies where operating cash flow is positive. Unless and until there is cash flow positive company, yes, there are new age businesses where cash flows are still negative and people invest in that. But again, that's a completely different model, and these are new age companies. But a larger strata of companies where cash flows are analyzed, and if only positive, we try to invest. Otherwise, negative cash flows companies we tend to avoid. Okay, and cumulative PAT versus cash flows. Okay, look, when I'm telling you that I'm looking at the bottom line and cash flows, my profit after tax should, over the long term period, match my cash flows. If PAT is higher and it is not resulting into any cash flow, I tend to avoid this company. It's very simple. Just look at the last 10 years, what PAT has been and what the cash flow has been. If it is not matching, there is something amiss, and we need to find out, and we need to invest in such companies with caution. Okay. Okay. Comparison with peer industry. Yes. When it comes to, at least you should have, we tend to invest in leaders. So if your sales growth is higher than peers, it's always a plus point. Increase in capacity and volumes. Look, production capacity is like usually company not use complete production capacity at one go, and like it is 50%, 60%. And whenever they increase their production as in terms of capacity utilization increase, it turns out to be giving them, it turns out positive because it gives them a operating leverage. and good sales and capacity volume CAGR is considered positive. So it's a sustainable growth which we look at. Okay. Now we come to very important part is conversion of sales into profit. Look, I've seen many companies where we have seen sales growth increasing, but it is not resulting into profit. So unless and until my sales is resulting into profit, either it is because of the discounts being given. We know right now the kind of discounts being given by new age companies. There was one company called as Canterbury Fashion, which used to give 50% and then again additional 20% discounts and all. So sales growth was visible, but again that was not resulting to profit. We know what happened to Canterbury. So that is the basic idea. Unless and until my sales growth is not leading to any profitability growth, it's an avoid. Okay, so look for companies where sales growth and profit growth is either equal or better. Then comes to, I told you that bottom line is a vanity. But and cash flows we need to look at. So conversion of profit into cash. Okay, what happens is we are trying to look at the companies where profits are there, but again lot of funds are getting into investment activities and or maybe financing activities. So what happens is it is not generating any cash flow. So unless and until it is generated, the company is generating any cash flow, I will avoid. Okay, flow is a bit difficult statement to understand, but what I am trying to look at, I will ask every retail investors to look at is, if my operating cash flow is positive and it is able to fund my investing activity and financing activity, I will try to invest in those companies. Okay, and last factor is value creation for shareholders. Look, history repeats itself. So if some company has created value for in the past, not necessarily that it will create similar value, but yes, if looking at the past performance, it has generated and created value for investors, we need to look at similar companies. I'm not saying that we avoid new companies or something, but if it has not created value for investors. Look, someone asked me which is next HDFC Bank, I say HDFC Bank. I'm not looking for any other company. Naturally, there are going to be differences of views in which company or which sector you need to invest. But if market cap has remained stagnant for always look for market cap. Don't look at any other. If market cap has slowly and steadily increased or improved over the year, that is one company. Look at the consistent flow of whether it is Colgate, Pidilite, Bajaj Finance. Everyone has been performing since last so many years. Okay, and they are there with strong asset base. So try to look at the companies where the creation of value for shareholders has happened. Not that the company has come up with something and it's a new buzzing idea, everyone is chasing that, but there is no share value creation for the investors. Okay, now last thing, this is the last slide of what I'm explaining. Having one stock is not possible. Look, I told you that even if that your success stories are based on investing in one stock, even your failures are not many when you only invest in one stock. So look, you need to put in your funds and your money into stocks with bit of diversification, and you need to make a portfolio. So what happens is there are four stocks which are underperforming as compared to the index. So what I mentioned was either it is the index you are comparing with, or it is the index what we are following as Nifty or small cap index, mid cap index, whatever. And there are certain which give you returns which are in line with the index. Okay, but there are going to be 2 or 3 stocks which are expected to give you better returns than the index, and those are the winners. What happens is we tend to keep our loss making companies in our portfolio and not the winners. People, what they do is like, I get 20-25%. Yes, I'm happy, I'm exiting that. We need to hold our winners. And that is what we at Rupeeting are following. We tend to hold our winners, and over the years, the performances will be, it's in open domain. So having a portfolio is very important. So there are good companies which are going to help in that part. Okay. So this is what I'm helping out, giving few of the strategies here. Fine. So this is I put up my presentation to end. Thank you. So I'm open for questions right now.
Yeah, thank you, Prasanna. First of all, apologies to the audience for running a bit late. Okay, but we open the floor for questions. So if you have any questions, just let us know. So I have one question, Prasanna. So this- do you think that a retail investor can make money in stocks by properly doing his or own research? I mean, if we compare the research that a retail investor do and the research that institutions do, so is it possible that the retail investor would be able to
Look,
identify quality stocks?
yes. Look, I told you that's the research or something. Investing is very simple, but we make it complicated. But there are few things a retail investor can do. Okay, I mean, what is the difference? As you mentioned about institutional or even HNI research desk or something, that is mentioned about quantitative factors and qualitative factors. The most important factors are quantitative is everyone knows it's in open domain, but it is the qualitative factors like management ability, management capabilities, where we need to engage with management. Not each and every retail investor is able to do so. Okay, and understanding management capabilities and business understandings and understanding of sectors ahead of the curve, where dynamics change very quickly, and retail investors not able to give that much in terms of time because of their daily routine. So what I prefer is, yes, if you are look, a study says if you invest even at a peak and keep your money invested for 5 years, you are going to get at least better than risk free returns. So if that is your time horizon, yes, everyone is able to find a stock which is good. But then there are certain requirements in terms of in-depth research, management interviews, and all. It is very difficult for retail investors. So what I suggest is, if you don't have that much time to put in and not having access to management, better to give it to experts rather than investing on own.
Okay. So another question that we have from Mr. Krishna is that should retail investors look into equity mutual funds instead of doing all this research?
Look, mutual funds is a good idea. I always support mutual fund as a good idea. But again, mutual funds have got some restrictions. Okay, what look, we need to understand what my financial goal is. Okay, and based on that, what my financial goal is very simple. I need to answer three questions. There are only three questions I must ask: what, when, and how much. So for what purpose I need that money, when I need that money, and how much. So unless these three questions are answered, I am not able to achieve my financial goal. So if your financial goal is into the bracket of 8 to 10% or 12% kind of returns, mutual fund is good. Naturally, you are not taking any risk. A little bit of this is there because of there are high growth equity investments are there. But if your financial goal suggests that you need 14 to 16% CAGR, equity is good idea. But if your financial goal suggests that you need between 8 to 12% or 10% kind of returns, mutual fund is good, where you need not put any extra efforts. Even in equities, you need not put any equity effort, where there also experts are in handling your money. Here also you are giving it to experts. It's very easy. Yes, if you want to invest on your own, try to keep it simple and don't try to be greedy. It's all about greed. You try to make more than 20-30% beating index, and it doesn't work. So we need to be very focused, and we need to be rationalize our expectation, what I started from my presentation from.
One more question is that, okay, how to identify IPOs, whether they are good or to stay away from?
Look, for me, IPOs are always no, because a lot of marketing efforts are put in to come out with an IPO. So we need similar kind of force from our side to deny it. Okay, so just look at these conditions. IPOs always come in favorable conditions, favorable to the issuer, not the buyer. So that is an issue. Okay, so look, I'm not saying that each and every IPO is bad or something, but I know over a period of time, uh, a lot of companies only take IPO as an exit route. We have seen in last 2 3 years how which companies have given exit to the PE investors, what they did, and lot of marketing and each and every effort is being put behind. Okay, so what happens is they come at very high valuations when markets are at peak, and then only favorable conditions they tap the market. So what I feel is, yes, they, if it is a good business, they are putting up money to expand their business, and that new money is going to generate cash flows. Yes, I'll invest it. And there is something which is kept on the table for retail investor. Most of IPOs don't keep that money for investor on the table, and that's the issue. So usually, as I am biased, I may be biased, but I tend to avoid IPOs. But yes, and what happens is a good IPO will get so much of over subscription that chances of getting into that allotment is very difficult. Even if you get a allotment, it's very difficult to sell because you are in such a bullish frame that you won't sell. And once it starts declining, you just hold it and you don't sell it. So profit. So there are so many filters applicable to IPO. Okay, a good IPO will get oversubscribed so many times that allotment is not possible. And when you get allotment, you are able to, if you are able to sell or not. So those are the good. So certainty, and there is a possibility. So I will go for certainty, which is in secondary markets. I won't going to go for a possibility which is may or may not happen. So IPOs for me, it's avoid. I will tend to avoid IPOs if I'm a retail investor.
So we have one raised hand from Mr. Hanmant. So I'll allow him to speak. Hanmant, you are on mute, Hanmant.
Okay, I can read
Can
his
you hear me?
question. So
Yes, yeah. So
yeah,
we
I
have
can
one.
hear you. Yes.
Yeah. Actually, Prasanna, it was a very interesting talk. But from my experience, what I felt was uh, now, in the hindsight, we can easily say like Pidilite was a good decision and Punj Lloyd was a bad decision, IKF
Right.
or SKS was a bad decision. But when you
Right.
are in that period during that
Right.
2006 or 2008 period, how to identify, like is it not very difficult uh, uh, to
For
like
retail investor.
find like whether it's a good stock or a bad stock, like what are the thumb rules or to be followed to make us easy in decision making?
Yes, as you rightly mentioned that it's very easy to say right now that it was a bad or good company. But what about right now? If I need to find out good company or bad company right now? Okay, look, I will give a very simple example for this. Uh, First thing is that when we enter into equity markets, okay, when we enter into equity markets, we have certain expectations or what our expected returns are. Okay, and then we take a risk accordingly. So there are certain companies, I will say, there are the bad companies which I will tell you very means you can go through my Twitter timeline as well, and I had mentioned about few companies much back like HDIL. Had mentioned about the companies management qualities. I had mentioned about ABG Shipyard when, like I mentioned, their interest coverage ratio was much more poor when in 2011 and 12. So people came to know about ABG's problem in 2016, 17, and 18. I had mentioned about it in 2013, 14 through which is Dalal Said Investment Journal. It's in open domain. So the points I mentioned about what to avoid, okay, those are very important factors. So I'm not saying that right now something is bad or how to find out, or someone says okay, I had invested at X point and I got a good return, but why you are saying it's a good company or something? I will give one example. Means again, when Jet Airways was trading at rupees 240, 250, and everyone was trying to buy it, my timeline was flooded with you are not invested. Even my clients asked me why you are not invested in data? Because we never liked it. So business had never liked, the cash flows were not good, debt were rising. So all negative factors what I mentioned were there. So every time it moved up by 100 rupees, I was questioned and I was told that look, this has moved up. But they had to be right at every time. They had to be right 10 times, and I had to be right only once. And we know what happened. So all those factors which I mentioned, what to avoid are very important. Very simple. It looks very simple. People would say, okay, itna simple factors, everyone knows. Then why we are making wrong decisions? Only problem is following it in a right principled way. Okay, even today there are certain no which as a portfolio manager I avoid. They have provided good returns eventually, but I tend to avoid and I stay firm to my decisions, because one day it is going to come out, and those at least out of those 6 factors it qualifies into 1 or 2 factors, and I tend to avoid. So I'm not giving the examples which were from the past. Even right now there are companies with unfortunately as a fund manager we have restrictions. I cannot tell them right now that it's a good buy or good or one must avoid. But yes, those 6 factors, if you follow very in a principled way, get to know this company is not good.
Okay.
Mhm.
Yeah,
Yeah,
thank
I
you
agree to
for.
your point. And one more follow-up question.
Yeah,
Uh,
please.
yeah, this is what I felt from my experience. Like there will be always losers in our picks, and there will be always winners. Like
Yes,
even
exactly.
because of uh, a cycle, the time where we are standing now, it also impacts the returns. And luckily, I
Right.
got to invest during the COVID time, and they all
Yes.
stocks were undervalued, so I could make good return. But
Right.
there are some multi-baggers, but there are some losers as well, like where I have lost
Right.
95% of the value, like
Right.
Big Bazaar, Future Retail, etc. But
Exactly.
just that, I think we have to minimize such decisions and maximize profitable decisions, and we should try to increase the probability where, like, there will be both. We cannot avoid bad decisions, just that we have to
Exactly.
try to
Exactly.
reduce them as far as possible.
Exactly. That is what. Look, I just mentioned in the last slide that there are going to be 3, 4 sectors, companies which are going to be underperforming, and there are going to be 3, 4 which are very much outperforming. So what happens? We need to put up our stop loss. Look, there are 2, 3. There is one very simple concept of risk capability, risk tolerance, and risk ability. So whenever you feel that this is touching my risk tolerance, where I cannot tolerate more losses into this, we need to avoid. That's a very simple concept. If you, I will share it, share that blog of mine with Ankit. We can share with everyone. So we need to understand our own risk capability, tolerance, and abilities. Okay, then only we can stop. Look, what happens is we tend to carry our losers. There should be a specified stop loss, which should be applied. Look, in fundamentals, they say there is no stop loss. If I believe in that particular segment, that company, and that story, I need to carry it over. But then there are done and dusted stories. We need not take them for longer in our portfolio, because there is opportunity cost which are paying for that. There are lot many other opportunities which are available. So we made a mistake. Yes, even we do mistakes. We had invested in few stocks which we didn't turn up accordingly, and we made losses, and we had to cut those losses. Look, if I'm running a machine and my fingers get into it, I will lose my fingers. I won't let my hand get into it. So let cut the fingers and move out rather than
Yeah.
losing your hand.
Yeah, that's actually psychological, I think, for retail investors. We don't know when to pull out.
Exactly. Look,
Yeah.
market and investment is 80% psychology and 20% finances, nothing else. So make
Mm.
your psych be so that it is more of patience and psychology that pays rather than the financials and your investment. So entry is easier, exit is difficult. Look, I will very put in a very simple way. So if you have decided to enter a stock without an exit in mind, it's our fault. So enter a stock with exit in mind. Always keep exit in mind.
Okay, yeah. So thank you for wonderful insights, Prasanna. So with this, we come to the end of our webinar. Thank you, everybody. and apologies for running it a bit late. One more disclaimer we want to make here. So there were some stocks that were discussed here. So don't take it as a financial advice. Always consult your financial advice before making investments. Yeah. So Prasanna, you may also would have to make the disclaimer.
Yes. Thanks a lot. Thank you. First of all, I'm sorry because I get overloaded for a few more minutes and all. But yes, stocks which I mentioned are stories which are, as I mentioned, that it's easier to put in examples from the past. But those are not recommendations. What I'm recommending right now. We have certain stocks which are part of our portfolio, so I need to make a disclaimer accordingly. So please do your own research and then only invest. And if you are not able to give time, better to give it to an expert. Look, if you are driving you can't drive a car and try to drive it and met with an accident, it's your fault. So naturally give it to an expert and it will help you out rather than putting your, and right now the market scenario is such that it's very confusing. Not everyone is able to make money. Whatever you see on Twitter are just screenshots, not actual. So try to put your logic, okay, and try to be very rational in terms of returns expectations. Thank you.
Okay. Yeah. Thank you, everybody. Thank you.
Thank you, Ankit. Thanks.